Good afternoon, ladies and gentlemen, and welcome to the Canadian Overseas Petroleum Investor Update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. Given the significant attendance on today's call, the company will not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and as usual, would welcome your participation. And I'd now like to hand over to CEO Arthur Milholland. Good afternoon, sir.
Well, good afternoon, Mark, and thank you very much for all that have attended. The last number I saw was 185, and this is a great number in what's in August, which is normally holiday time. So, a welcome, and what I'm going to tell you about here today, which we decided to do this before we put out our press release on Friday, was to go through our resource report, and it's as I've said previously before to some, that it's not as simple as a straightforward analysis as some think. But that said, I'll try my best to explain it, and as well talk about our production in the field of the miscible flood, and what we're doing there, and as well as Ryan will lead in at the end as sort of an update on where we are with our refinancing of our credit facility. So with that, I'm going to start, and again, welcome. The first two pages here are the normal disclaimers that our legal counsel we put up, so there's nothing really there to talk about. But the key thing, as I said, the agenda for the meeting, we're going to talk about the discussion about the resource report. We'll talk about the production operations and update of what we're doing in the field to mitigate the issues that we've been facing here for the last 8 or 9 months. And then we'll talk about what our plans are for the deep discovery here going forward. And again, you've got Ryan for who's on the line here for the last part. So before we start here, the first slide here is actually a distinction of what the difference between resources and reserves are. And if it's apparent to me from some of the emails that I get and from the reviews that others that do work for us, or even myself that look over the chat on the online forums, that there's a really a misunderstanding between resources and reserves. Now, we are a Canadian company incorporated in Canada and under Canadian securities regulations. Because we trade in Canada, we're considered to be a Canadian reporting issuer, which means that when we do reserve and resource reports, we are obligated to use Canadian standards for those, which are much, much different than the standards that in the United Kingdom or in the US that people are used to, where the standards are kind of loose, and they're based upon standards put out by the Society of Petroleum Engineers and the American Association of Petroleum Geologists. But in Canada, a number of years ago, almost 20 years ago, it changed, and primarily because of scandals. So if we look at this little picture on the side, is that right in the bottom in light blue is what's called resources or prospective resources. And then above that, you have contingent resources, and then above that in green is reserves. And the classifications for reserves are, what they call 1P, 2P, and 3P, which are proved, probable, and possible. And then in contingent resources of 1C, 2C, and 3C. And contingent resources are the criteria for evaluating things as contingent resources can be many, not just economics. They can be rather if you have permits, in other words, permitting issues, or environmental constraints that you can't apply to until all those hurdles are met. That's the way that they're listed, or just stepping away from proved reserves, and you'll see that in a moment. The key thing to understand is that it's the progression through time, is that things will start off prospective resources, and there's different levels of prospective resources, into contingent resources, and into reserves. And so in our case here, the main thing is that if you're looking at what we released was a resource report, and there's both contingent and prospective resources, is that the each has a different criteria. The key is that the regulation only allows for the evaluator to put those number on lands that the company holds an interest in, not essentially on the size of the map or the mapped potential or accumulation. And it's up to the evaluator to determine what lands that they include in that. So if we I'm going to turn to the next slide. And so this is taken from the report, and in yellow is our current leasehold position in the area. And post the acquisition of CUDA, we have 85% working interest in the Barren Flats Federal Deep Unit, 100% in the Coal Creek Unit, which is outlined in red, and then the non-unit lands would have 100% in, and they're outside of the boundaries that you see there. In red, dashed in, is from Ryder Scott's interpretation of what the limits is, what they evaluated. Now that outline is much different than our outline internally, and we'll talk about that here in a moment. But again, as I said before, it's up for them to determine what they're going to include and what they're not going to include. And so why I'm going through this is because on Friday and over the weekend, there was much conversation and communication saying, well, you fellows don't know what you're doing, and the numbers may be a little smaller than what we expected. And so what I'm going to show you is what the differences are. And most importantly is it's Ryder Scott's interpretation. And like anybody else in the world, they have eyes on it, and it is what it is. But it is much different than what we see. So first off, in the press release on Friday, and this is their net pay map for the Frontier 2, is that, and in there are a number of horizontal well locations. There's 89 identified for the Frontier 2, and you can see them plotted on the map. And then the lands that are colored is that each square, and this is as surveyed in North America, is 1 square mile. So it's 640 acres, which is a mile by a mile, and a large square. Or if you live in the metric world, it's 256 hectares. The colors, to explain to you, is the green is the area where we have proven developed and proven undeveloped reserves for the Frontier 2 at Coal Creek. The yellow areas in the square are where we have P2 reserves, or 2P reserves, which are probable developed and probable undeveloped reserves at Coal Creek. And then as we go outward from that area, because the zero edge of the mapped accumulation, where we've got a lot of well control, is on the west side of Coal Creek, is that we go into an area of C1 contingent resources in orange, C2 contingent resources in red or pink, and then C3 contingent resources in blue. Now, that is their determination. And if you can see this, it's tough to see, but there's a bunch of cross-hatched acreage are lines on sections there. And those are lands that we will currently leasehold, which are to the west, to the north, and to the south. And bound by their interpretation of the zero edge on the west side of the accumulation of the oil accumulation. I've also put on there the location of the 14 to 30 discovery well we drilled in September. Now, one of the things that's known that I need to mention here is that this mapping is all done by interpretation. There is no way to understand or to today to pinpoint where exactly that zero edge is, but we can certainly have a few clues about it. And remember, I'm by trade, I'm a petroleum geologist. I used to draw maps in my younger days and find oil, and I found an awful lot of oil in my life in Western Canada, in the United States, and in the North Sea. And so I have one or two ideas. And so the thing you would do is you would, if you can see my cursor, you would go perpendicular to the trend, straight across where we've got control points. And that mapping where we've got control would be the width of the sand body. Now, as you by genetically, what these are offshore shelf sandbars, ancient bars, and they do have a trend to them. And in this case, the trend here is northwest, southeast, and parallel to the what we'll call the original old shoreline during the time in the Cretaceous, Upper Cretaceous, when these were deposited. And so you can predict the trend and the orientation of the trend pretty good, and it does shift a little bit to the north here, and there's a turn, but you generally know where they trend, and by analogy in other fields, you know what kind of they look like in the subsurface. So in this case, there are time equivalent sands to this in Alberta called the Cardium. Lots of oil fields in there, and they look almost identical on our wireline logs, and you can map them the same way. So they've got an interior geometry to it. So again, is that the contingent resources that and the trend of that is really based upon what they included is that far zero edge. Now, what I'm going to show you here is on the same footprint and in our internal map, and you can see that what I quoted in the press release was that there was 217 million barrels of oil in place in this area. And one of the things I noticed here was in the commentary was, well, how come he included the C3 numbers? Well, the reason why I concluded the C3 numbers is because rather than doing it probabilistically is saying, here's the whole volume, it's actually not, is that, here's where the well that we drilled, we've got proven and probable reserves over here. The main thing to understand is that they've considered this to be one large oil field with an anticline imposed on the west side, which is a big deal. And that's the really important thing to take away from it. And then, of course, the net pay is open to the south. Now, from our standpoint, is that we look at the C3 area here, and there's a well up here with over 20 feet oil pay in it, using their numbers in 26, and not much less than what we have here, and saying, what's over here? So our drilling is going to be in the area around this well, not in close to the Coal Creek field, because we know that. We've got wells that are producing there. Small amounts, they're old vertical wells. But the plan is to drill horizontal wells. Now, I'm going to flip the page here and say this is basically on the same print, and this is our internal map. Now, what's different about this? If you go back and forth, you look, the north end's pretty much similar, but it's contoured differently. The other map was contoured at 10-foot intervals. This is down to 2 feet, and this is taken from a hand-drawn map that we have internally, and it was digitized by one of our fellows, so we can calculate a volume off it. And as you can see, it looks much different. And when you take the interval down to 2 feet, you can actually start mapping the geometry of what the sand looks like, which is back here, which is just looks like a blob. And frankly, when you look at these things, they don't look like blobs, you can actually look at them and say where the trends are, where the thick trends are. And anybody that's gone out near shore from a big beach, and if you've been down to Florida and go out in the sand off the beach and into the water, you've all seen sandbars. Well, maybe these are like old sandbars, and then you walk up and sometimes the bar is high, then you got a swale, it's low, and it becomes high again. And that's effectively what we're seeing here. So the blue and magenta colors are the zero edge, and the colors up to get hotter would be the thicker areas in the trend of the sand. What's different is that we've maintained the thickness across, as you can see across the top is the other map, but we've trended to carry it down to close to the control point to the south here. Now, this well's a bit of an enigma because it's produced oil and it was called the Frontier 2. There is some discussion whether it's a slightly older cycle of sand or it's the same. And frankly, we're not sure. So we've chosen to take it out, but we can put it back in and shift it over a bit. But it's thin. It's made 117,000 barrels of oil. So, but it's not going to shift this line very much either way. But the big difference is if we take the same estimate of volumetrics and calculate the volumetrics in this, we can come up with 351 million or 352 a million barrels of oil in place versus the 217 calculated by Ryder Scott. And so what I'm saying is that all of these things are interpretations. Is one more right than the other? No, it's just one person's view on it. What do we run our business on? Is this one, because I've been in the business close to 40 years. I've found lots of oil. Our geologist that works with us, he's worked with me for almost 30 years. A similar thing, and so that's what we run with, and that's what we base our decisions on. But again, you can see that the net pay is open to the south, and the valuation stopped at the solid thick line here, the township boundary. And so we have leases down to the south. And so when we look at our overall number that we released in January, it's based upon the extension of this on our lands to the south, as well as up in here to the north and the northeast, where again we had wells that tested oil. Now, in the case of the Frontier 1, is that what they chose to do, because it's a series of cycles of the Frontier formation, and there's 3 sands in the Frontier 1, and they look very similar to this, and they're all stacked up on top of one another. So they basically took their Frontier 2 map and said, well, we're just going to find the same thing up above. And there's some logic to that, and frankly, we've done similar things similar way ourselves, is because you tend to have these things stick on top of one another when they get all stacked, and they can be similar thickness or thicker. So in effect is, if you want to kind of recreate oil in place numbers for the Frontier 1, you can kind of get close. But the sands in the Frontier 1 are thicker, so there's higher volume in them. And so it's not just such an easy thing as to say, okay, I'll take 3 times the oil in place number for this and say, okay, that's it for the Frontier 1. We have to account for different average sand thicknesses, but the aerial extent is what they're keeping it the same. And that's how you get larger numbers. And so, but what's most important is when we target our evaluation, the first well we're going to drill is for the Frontier 2. And it's just going to be offsetting in the same section as the 14 and 30 well. And as I said in the RNS, is we're going to core the Frontier 1 from top to bottom. And what's the reason for that is because we can take in a car not far from here, because the unique nature of the Powder River Basin, and we can go out on a cliff face and we can go look at the Frontier 1 and outcrop. And what we're seeing is the series of sands, and we're seeing what appears to be much more sand porosity down below, or finer grain sands that would have storage for oil than you can much appreciate off of the open hole logs. And so we kind of look at the Frontier 1 as almost as a conventional resource play. is having a lot of entrained oil. So that based upon looking at that is to give us an idea where we place our first horizontal well in the Frontier 1, which is going to be well number 2. And it's going to be on a pad either to the north in a blue section here or at the same pad. We haven't decided yet, but we have permits that allow us to do that. And then the right now is to put a horizontal well right in the middle sand and with a large frack up into the upper sand and frack down into the sand below. And we can do that. So one of the questions we've been asked is that, are you going to frack these wells? And the answer is yes, you have to. They all suffer formation damage in the near wellbore, wellbores. They all have. And the only way you can get by the damage from drilling is to frack through it. And then in this case, if it's got storage, all as a fracture does is open up in a conventional reservoir, is that it essentially makes it, from pressure-wise and production-wise, appear thicker. So each fracture is in contact with porous and permeable sands, and the oil flows in and down into the wellbore. It's very straightforward. The next slide is showing what we look at in difference to the slide that I showed you above, what we based upon our press release in December as a blob map. And as you can see here, that the north side in our base case somewhat follows the map from their report of where the north side of the trend is cut off at Parkington Ranch. But the south side and the southeast side continues back down into our acreage trend. And as you can even see from their net pay map and our net pay map, that the net pay comes all the way down here as well. The next thing is to look at what I commented on earlier. This is our high case. Is what does 51101 have to do, National Instrument, with the Frontier 1? Now, because right now that at Coal Creek we have the Frontier 2 is producing there, and we have a number of old wellbores that the Frontier 1 is there, okay, over top of the Coal Creek field. But to this day, it hasn't been perforated. So we have vertical wells, some that aren't producing or low productivity, that we can go in and suspend the Frontier 2 and go up the hole and perforate and complete the Frontier 1. Now, if you do that, then those prospective resources and get production will turn into reserves, just like the plot that I gave right at the beginning. The next thing is that by our regulations in Canada is because on this lease block is that on the edges of our lands are wells that actually produced oil out of the Frontier 1, but they're not on our lands. And I think that's a critical thing to look at. So if we go down just a mile south of a mile and a half south of our discovery well was a well drilled in 1952, and they perforated the Frontier 1 from top to bottom, all three sands and one set of perforations. So 172 feet of perforations. Back then was before fracking was invented, and they just gave it a little bit of acid to clean up the damage in the mud, and it flowed oil, produced oil, very low rates, but oil came out of it. And then up on the north side, way up here, is a well with a red arrow that drill stem tested on penetration the uppermost Frontier 1 sand and got 170 barrels a day in oil to surface on an open hole drill stem test. And then another old well, and then they attempted a completion. Now, we know from our well that we drilled that the sands are a little under pressured, and they're susceptible to formation damage. In the case of the three Frontier 1 sands, we lost 1,000 barrels of drilling mud into them while we were drilling. And if you think of what's 1,000 barrels, well, there's 42 gallons, U.S. gallons per barrel. So that's 42,000 gallons of drilling mud into the reservoir. That's a lot. And as well, when we cemented the well, and then you have the sheath of cement up the casing. We can see where the cement losses are on the bond of the of the cement sheath, because we run a tool in the hole to measure the bond, the quality of the bond, and we can see where the cement took off in the formation. And plus, when we perforated the Frontier One and swabbed it, we got a little oil, but we were getting barium sulfate back, which is essentially weight, the weight that they put in the drilling mud, filtrate from the drilling mud and the cement in the water. So it was basically induced water, not formation water. We send it to the lab, we get an analysis of that, we know exactly what it is and where it came from. So because of that, where we are is that had to be looked at as resources. Now, I'll give you an example of how it works. So in Canada, Western Canada and Alberta, there's and into British Columbia, there's a large, some of you may be familiar with it, there's a large resource play there called the Montney. And the Montney is a basin-wide resource play. They call it a shale play, but it's not really shale. There are thin sands in it, some thick ones, and it covers a very large area. But if in the early days, and even today, if you have leases in the Montney Trend, in the heart of the trend, and there are no wells on it, but you know it's there, okay, and you've got fields to the north and fields to the south, but nothing on your acreage, the evaluator will only give you prospective resources. They won't give you contingent or proved. In the United States, though, on the other hand, at the height of the shale plays in North Dakota and the Bakken, or the Permian Basin, Haynesville Shale, the Eagle Ford, pick one, is that in difference to that, if you had leases in the middle of the basin and they knew the whole area was productive, you would get proved and probable undeveloped reserves. And under the way banks in the U.S. at that time were lending money, people went down to the bank and borrowed money to go drill the wells. So we can't do that. And so again, it's just fitting what we're doing into the regulations that we apply to us. But we know that, and are quite confident that that's what's here. But most importantly, until we collect more data on this, like for instance, the wells I mentioned was in 1952, we need a well core. We need some modern day well logs on it. And I'm maybe saying my age, but these old electric logs that were run in the 50s, most people that know how to deal with them are either dead or long retired. When I was young, I took courses on how to interpret them. And so I know how to interpret them, and fellow works for me knows how to interpret them, but not a lot do. And so they all tell you a story, but are they modern? No. But don't forget, most of the oil resources in the world today, in the Middle East, things were all found with these things. And so they do tell you things. And so that's what we're doing. We're confident in our interpretations, and we're going to move things forward. If we look at the Dakota, again, the Coal Creek field here is the proved reserves for the Dakota are in green, and they're called P1. The probables are P2, and they're developed and undeveloped. And then you can see as you go away from those, then you get contingent resources. And so just like the other map is that you've got, in this case, it's C2 and C3, not C1 contingent resources. And they're a function of the distance away from the existing proved reserves. Okay, so that's the uncertainty. In other words, and that's why they're contingent. So you see our discovery well here. These two sections are proved, and then the lands in between are probable. So the proved and are contingent. So the proved and probable reserves, P1 and P2, are in our year-end reserve report. Now you will see, near the end of this month, we're working on an updated report because now we have CUDA to change the working interest and things, and so that will be coming along, and then away we go. Now, what's the difference here between the Dakota, what we think the Dakota is, and what Ryder Scott is. Well, this dashed line over here is where they think an oil water contact is. Now, there's a lot of weird things going on in the Dakota because I've got a well over here, which is on our acreage, which drill stem tested oil in the 50s, and it's there. And in fact, there's another one just off this map that tested oil cut mud, some damaged. And so we would say, but not water. And so when we get down to the south here, there are a couple wells that they think are wet, but there's, just straight south of it, the same elevation as one of these wet wells that made 350,000 barrels of oil out of the Dakota. So we actually don't think these are Dakota sands, but that's our view. And then you have to explain, well, if that's water, then how do I get oil at down dip of water? In other words, this basin's like a big U. So as you go to the west, you're going higher in elevation. As you go to the east, you're getting lower in elevation. And if any of you have made salad dressing and mix oil and vinegar, shake it up, let it sit, the olive oil goes to the top, the vinegar goes down. And so the basic concept, as we call it, is because of density, natural gas sits at the top, then oil, then water. So if I've got oil at a lower elevation than where the water contact is, you got to try to explain that. And either it's another sand or it's separate that's developed there, or there's something strange going on here and things kind of move around. So if we look at where we thought the Dakota was, and we looked at that and said, here's all the penetrations of the Dakota. Red means they produced oil. The other ones, they went through it. But the ones that were apparently wet, our guys don't think they're Dakota, so they're not on there. Could be, it's another sand. Okay, that's wet here. Well, whatever. So in all this stuff is the oil test I showed you. It was right up here. This dot over here, oil cut mud out of the Dakota. We produce it all up here to the north. Old wells that had produced out of it. And so, again, it's a difference in interpretation. It doesn't mean we're wrong. I'm not saying they're wrong. I'm not saying they're not saying we're wrong. It just means that, we go back and look at things again. Now, I also said we didn't get this report until the 29th, and it's about 80 pages long, and it's a big read. And so, it takes us time to go through all these things. The next thing I'd like to update you is we get asked about a lot is where our production is. Now, as I've mentioned, we've mentioned in many press releases and updates like this, is that we've got, some fairly, we're dealing with a lot of very high pressures at surface, and this started to manifest itself in August and September of last year. And we thought maybe it was unique to this particular well because it was a horizontal well that the original owner, Chesapeake, drilled into the field. But what we've been finding, and we've resimulated the reservoir, is that this miscible front is moving through the field. And now on Very, we've had 4 other wells go from pumping to flowing, and it's becoming predictable what the trend is. And so we've converted 3 of those to flowing wells in the last month and a half. And we've got a 4th one, which we're about to start work on, and to get these online. Now, we are trying our best to deal with the facility issues, constraints at surface. We've gone back and we've looked at all the simulations. We did it in our due diligence when we bought Atomic. And we've gone back and looked again, and it just can't handle these pressures. And why? Because it was designed off of an original simulation of when they designed this miscible flood, and nobody ever thought that they would see this kind of response. And when you see this at surface, is that the reservoir is behaving much better than anybody had thought. And when I say they start to flow, these wells are wells that went from pumping 40 barrels a day to flowing up through the tubing and the pump and the rods at 200 barrels a day. And it almost happens overnight. And then like within a few days, and then the pressures start to come up after it. And so, we were facing with pumping wells, facing working pressures at surface that were climbing up 1,000 psi. Well, a pumping wellhead isn't designed to do that. You can't shut the well in if you got a problem. You can only produce it. And so, of the three that we did in starting in late June and July, and it costs about $250,000 a well to do this, is one of them, the third one, we had a problem with. And the problem is that we had a service rig on, rigged up, and to do that, you got to kill the well. And we had 1,300 psi at surface on the tubing and 1,600 on the casing, and we got to kill the well. And while we were rigging up to kill the well, we had a flange on a valve split because of the pressure, and we had a little uncontrolled flow from the wellhead. Now that slowed us down for a couple of days. We did manage to get the well killed and everything's stable. But what it says is that these pressures are extremely high. And today that well has been rigged up. We've got it flow testing here today. And it takes a number of days to get these things flowing unstable. But fortunately, it's very close to our plant, gas plant. And so we run a temporary line right from the wellhead and the separator to our gas plant, and we can take the gas directly into the plant that comes with it and bypass our gas gathering system, which has got limitations. The other thing that we've done here is that because we've had these very high pressures at surface, and our permit doesn't allow or hasn't allowed us of the field to flare any gas. Now, the first assumption is it's environmental. Actually, it's not. It's for the payment of royalties. And when they originally got the permit for the miscible flood, is that what they should have done is asked for a field-wide flaring permit in case of problems, and we don't have that. In Wyoming, the regulations mean minimal gas flaring, and that's because unless you're paying royalties on the flared gas. And because the leases here are a combination of federal leases, state leases, and freehold leases, is that if it was a normal primary production oil field, you'd either have to pay the royalties on the flared gas to the royalty owner or hold your gas back from flaring. And a lot of states in the U.S. are like that. Now here it's different. We own the gas. Okay, we've been injecting, there's been 3.4 billion cubic feet of enriched gas injected in this reservoir that was paid for. About a third of it was paid for by the previous owner of Atomic, and we paid for 2/3 in the last year. And we own it. It's ours. And that's quite clear in the permit that it's our gas, and that if we want to burn it, to flare it, that's our problem. And so we've gone back to the state and said, look, we got some serious safety problems here, is that we have to be able to allow to bleed these pressures down. That cuts our working pressures down. Our gathering system can't handle it. And so a proportion of this gas we're going to flare. And then, that allows us to get in balance. But most importantly, we need to get some numbers, real numbers on what we're facing, so this thing doesn't get under designed again. And we started off with a number they gave us a volume in June. It wasn't enough. We went back to them after we had the uncontrolled flow at the well. And then the light bulb, their field engineer was out there while this was going on in the kill operation to kill it. And the light bulb certainly went on in his head when he's seeing what's going on. And then we got a bigger number. And then to follow that up, in September, we have a hearing with the Oil and Gas Conservation Commission to an application to allow us to flare what we want to flare and to get things stable. And we've got a good reason to do it. It's safety. It's quite clear that the gas belongs to us. And but it's not, in the whole scheme of things, it's going to be a temporary solution, but it allows us to debottleneck things and move things around. The fourth well we're going to convert as the third one is tied directly into our plant, it's close by too, and we're going to tie it in as well. And that takes the heat off. Now, in the time being, we're ramping these wells, the three up. It takes time to get these things at stable, because when we put them back on flowing, they're flowing at start off about 12 to 1300 psi, and we've got to get the flowing pressures down to 500 or 600, and that takes some time, like a week or two or longer, and more important, getting flowing stable. And so we're into that process. So our production is ramping up slowly, and because we had these big wells were basically down in June, so our production dropped. Some of you go to the Wyoming Oil and Gas Commission, but that's why they dropped, because we just couldn't produce them safely. And so, we take safety seriously, and it's not an excuse. It just is. When you have a problem with these, problems can get big fairly quick. The other thing that we face here in the field, which is interesting, is paraffin and wax. Now, we've always known that these wells, the oil is a little paraffinic, and as all oil in the Powder River Basin is waxy, but not a lot of wax, and it's enough to be a pain in the neck. Normally, this wax will come out in the tubing string as it reduces temperature. Okay, so when it comes out of the reservoir, it's about 100 plus degrees Fahrenheit, and as it moves up the tubing string, it cools off in a pumping wells, and generally, it starts to coat things about 1,500 feet from surface. And so on a regular basis, we treat all these wells with hot oil, and what we do is we take produced crude, heat it up, get it real hot, put it down the well, bring it back up again, and it's just like dealing with candles, it just melts it and moves on. But one of the things that we've been seeing here is we've been seeing some very anomalous things, especially if these wells that go from pumping to flowing, on the amount of wax that comes in them. And we should all remember, we've injected enriched gas in this reservoir, which is a combination of methane, butane, and propane, but mostly butane. And the butane is a solvent. It adds another phase in the reservoir, as well as we've increased the reservoir pressure from 2,200 or originally 2,400 psi was the original pressure, up to 3,400, 34 to 3,500 pounds per square inch. So we've changed the dynamics of the reservoir by pressure, as well as introducing a solvent in the reservoir. And what we have been observing, and you have to understand, the only thing we can do is observe, okay, is that wells that have been flipping over from pumping to flowing appear, all of them, that have more paraffin issues before they start to flow. And then of course, as they start to flow, we get more oil rate going up the tubing with sucker rods in the hole. It adds friction, it adds temperature, and maybe melts it out. But we've got more wax plugging problems in that time period before. So, as an operating cost, every time we haul hot oil or out to hot oil things, it's costly. Now, there's lots of ways to treat wax, and the traditional ways are with hot oil and with chemicals. Now, in my past, 25 years ago, I had a bunch of paraffinic wells in Canada, low rate, that were kind of a pain in the neck to produce. And I went through all these things before and finally settled on cleaning them out with condensate. And so what condensate is you can buy it from gas plant. It's just call it Mother Nature's gasoline. And it's very volatile. It's basically either somewhere between gasoline and naphtha. And you clean it out with condensate. It strips all the body wax off. And most people don't like to do it because of its volatility. Now, on the other hand, when we produce our oil, because of the butane entrained in it, it's extremely volatile. And believe it or not, condensate's less volatile than our produced oil. And we've got vapor recovery systems in our tanks and things. So we can handle it when we produce it. And more importantly, we can handle it safely to transfer it from a tank and put it in a pump and pump it down the wellbore. So we've taken 5 wells that are offsetting these wells that are flowing now, and they're got appear to have paraffin because they're not showing a response, a lot of paraffin, and to clean them out. Now, we'll see what happens. It was just last week and how the week goes, but we expect to see a response of them. And the nice thing about condensate is certainly we pay for it. So it's basically the same price as crude oil. You put it down the wellbore, you produce it, and then you get it back. And so really the net cost to us, there's some percentage, probably 5 to 10% will flash off on us because it's volatile, but we have vapor recovery on our tank, so we won't expect much of that. And for what we buy, we sell back. And so it really what the cost is the cost of putting it down the hole. So we're doing things to manage what we're up to. But the most interesting thing was our field people. We did the condensate treatment last week, and it's not something that's normally been done in Wyoming. And we heard an interesting thing in the field was, it's interesting you're doing this because Continental Resources bought Chesapeake's oil production in February in the Powder River Basin, and that's what they're doing to all of the Chesapeake wells with very good success. So I didn't know that. They didn't know we were doing it, but we've started the same thing at the same time because somewhat out of frustration is that we'll clean things out. So you will see production start to rise. And truthfully, a lot of these things, we knew that Dakota was going to close, and it did. But our hands were really quite tied with the receiver, is because we were limited, though they owed us a lot of money. We were limited to what we could do because we needed their approval. And with things that were high cost solutions, they did not have the capacity to front money to us. So we would have had to carry them along. So it just happenstance was that a lot of these things happened in June, started triggering in June, and we just went ahead and did them, right? And CUDA closed, and so on we go. I can certainly understand if shareholders are frustrated by the production levels, but they are going up, and a lot of these things is just as for us to find a solution for it. And I'll give you an example of what this looks like. So this is a picture and of the tubing that came out of a hole of another well, the pumping well here last week, and what we're facing. And so this well on the north side of the field is somewhat gotten a scratch in our heads. And so how it started was that, we were pumping this well, it was making about 40 barrels a day, and it stopped. And so, the first thing that comes to mind is it needs a pump change. And so the pump is down about 56 feet, 100 feet of subsurface, so over 2 miles, over a mile, 5,280 feet to a mile, and it's about 5,600 feet. And so we started to pull the rods in the pump, and nothing wanted to come out. So we eventually got all the tubing, and this is 2 7/8 inch diameter production tubing, and you can see the hole in the center and is where the sucker rods are. Everything else is wax. Now, normally I said the wax would be up around 1,400 feet below surface. This thing was plugged with wax right from the surface all the way down to the pump, and in fact, it was the wax that lifted the pump off its seat. Now, that's got us even scratching our heads even more, is why we got wax down so deep here. And as I said to you earlier, where this well is relative to an injection well, we were seeing higher increases in waxing problems on pumping wells, but we can't put a camera down the hole. And so when we see a reaction of a pump plugging up, as this one did, is we pull it all out of the hole, and because of we had to pull the tubing out of the hole too. And now it's all been cleaned at surface and we can clean it at surface with steam and a vacuum truck and get it cleaned out. But this has got us really of why, okay? And And as I said before, there aren't any easy answers to it. We can't calculate why. We understand the phase of the reservoir when it was originally, and but we've induced butane in the reservoir at a higher pressure, so we've changed things. But this is telling us something, and it costs about $30,000 to $40,000 to pull all this stuff out of the hole, and it's out of the hole. Now we got to understand it, and it's going back in the hole clean. But once it gets on bottom, we're going to shoot down below it some condensate to clean it up, because if it lifted off the pump, right off its seat, there's something here down below we've got to clean up. Now, the good news is what it's telling us is this miscible front is moving through the field. And we see that because of the flowing wells that we have and the pressure increases that it is. We're starting to resimulate the reservoir again. And that this would be well number 6 that we're going to treat. We did 5 last week. And as it's moving through across, is if it holds true, then we expect that these wells will start to flow. Now, this well was pumping 40 barrels a day up until 10 days ago. Now, you tell me how oil was coming up this thing. I don't know. It around that little hole in the middle with the sucker rods is the only thing. So we'll see what it does when we get it back on. But these are the kinds of things that we're facing. They can all be solved, but it's like everything else in life. You can't solve a problem until you know what we're solving. And this is a brand new oil field. And I'd like everybody to think about that. It's one of the very, very few in the world that when they started miscible flooding in it, went right after primary production. And normally they would inject water before that. And so there's a lot of things going on here that even the reservoir engineering firm that we have working on this, called Independent Reservoir Technologies, it's all responding the way it should, but there's an awful lot of the way it's responding is causing all of us to scratch our heads. Now, as I've said previously, if the reservoir wasn't responding, we would have a real problem, because you can't fix the reservoir. But all of these kinds of things we can fix. And if it means that we treat them with condensate more often rather than hot oiling them, wells like this, we can mitigate that. But once we've seen it, we know what we're dealing with. Last but not least, we're going to talk about what our steps are for the discovery well. As I said, in the discovery, in the Frontier 2, in the Frontier 1. For now, we're going to leave the Dakota alone and focus on the Frontier sands. Our intention is the first 3 horizontal wells we're going to drill are targeting the Frontier, 2 in the Frontier 2 and 1 in the Frontier 1. The first 2 Frontier wells will be nearby our discovery well. One will be a Frontier 2 well, and that's the first one we're going to drill. On the way down, we're going to core the whole Frontier 1, and the second well will be targeting the Frontier 1, and we've spoken about that. The third well will be at Coal Creek, and to see how it works there on an already permitted location, because the previous owner of Atomic had planned to do one there a number of years ago. But what we're waiting for before we can say, when are you going to do this, is steel casing. Oilfield tubulars globally right now are in very short supply. We've got about half of what we need. We've been looking for casing for the last 2.5 months. It just doesn't exist. And for the certain grades that we need, we got a well design. We're going to set casing up above the Frontier 1, because we've got high pressure sands in the Shannon where we're miscible flooding. We've got to have it behind casing, and we know the formation is susceptible to damage, so we can cut our mud weights way down, and there just isn't casing. And why isn't there any casing? Well, there's a war going on in Ukraine right now, and the Russian mills and the Ukrainian mills are the Ukrainian mills are offline, the Russian mills are sanctioned, and they were large suppliers of steel into the oilfield tubular market globally to make it. So there's a shortage of tubing, and so customers that would normally rely on those tubings are coming to North America looking for casing. It's gone up in the last 6 months, it's increased in price by 60%, and it just isn't around. And so we will find some, and once we find some, then we can commit to a date for our drilling rig that we've got identified. But there's no use for the company to commit to a drilling rig and pay standby charges on it or penalties on a contract if we don't have casing to drill a well. Now, I've talked to the drilling contractor. I met with him earlier in July, and he's got other customers that got the same issue. And so it's not as if that it's something that's our problem. It's an industry problem. Now, what's causing it is that we know of large operators, especially in the Permian Basin, who are hoarding casing, and they drill maybe 200 wells or 300 wells a year. And so they're buying all the casing and holding it in inventory, whether they need it or not. So as I like in jest, I would say that those of us went through COVID and lockdowns. You went to the grocery store to buy paper for your bathroom paper, and it was gone. And people buying boxes of it, and you asked yourself, well, I wonder why. But in some respects, that's what's going on now. But it does show up every once in a while. And we got people looking for it. We got suppliers that know what we're after and the weights and grades we need. So once we get that more firm, we'll announce it. But right now we've penciled in early November, and let's hope we get our casing secured by then. But we do have about half of it. But we need the critical casing. We need is the intermediate casing to go from the base of our surface casing down to the intermediate casing point, and it's a certain size and a weight, and that's what we need in our well design. And so that's where we are on basically the resource report. And then Ryan is going to take over next and talk to you about where we are and looking at our refinancing our senior facility. Over to you, Ryan.
Hi. Yeah. So I think over the last 2 years, I think what a lot of investors don't realize is that what we've done is acquired 38 million barrels of 2P reserves in the United States, and we've done so for less than $2 per barrel, which is a pretty significant metric in the market right now, and certainly at a time when majors and other oil companies are aggressively looking for assets or projects to deploy capital. I'd like to point out too that we did so using $45 million of debt in 2021 from our senior credit facility, and with $9 million of equity towards Atomic. And the recent convertible loan we raised is instrumental in this next step of securing an RBL. It allowed us to acquire CUDA at a very attractive price. And moreover, it's structured very specifically in a way so that it works with the current senior credit facility that we have, as well as enabling us to draw down on a senior bank loan, which is something we're negotiating. We're targeting drawing down on that in the fourth quarter of this year. So we've appointed a specialist debt advisor, and we've been working with them since Q2. We have met banks. They are focused on the E&P space. They're not a broker that you're used to in the equity market. They're explicitly debt advisory and origination, and they do work on behalf of numerous banks. They're based between Europe and the United States to give us breadth of coverage, and we're working with them right now to structure updated models based on our reserves. I'd note that very particularly due to a number of the questions, the resources that Arthur's been discussing for the last hour are not the reserves on which our asset-backed loan would be based. So the reserves are primarily the Barren Flats unit, our primary production, and the Coal Creek unit. And that's what forms our borrowing base. So the CUDA acquisition was instrumental for us because of two primary factors. So one, it removes a bankrupt partner that we've been carrying, and we've been out of pocket carrying since we acquired Atomic in March 2021. And moreover, it provides us with total control of the producing units that we operate. So this was absolutely a precursor to getting an RBL and to ensuring that we can get an RBL with terms that are going to be suitable. We certainly expect it to be lower cost than our current senior debt. And we're working right now on a reach out program with banks and plan to announce term sheets or to provide an update on this financing before the end of Q3. So we expect our borrowing base to be based on a 5-year term. The borrowing base is a function of two things. One, the underlying asset value. And as I mentioned, we've done a great job of acquiring that at a very low cost for shareholders. And we expect to see a senior credit facility as well as a junior tranche in behind it. The senior facility, we expect a borrowing base of $50 to $60 million, based on our current 2P reserves. This is based primarily on the proven developed producing reserves over a 5-year cash flow term. In behind this facility, we see scope for a junior tranche, and what that junior tranche would typically do is to help provide financing for infrastructure, which banks like borrowing or lending money for, and otherwise for drilling and development capital. The junior tranche can take a variety of forms. We've had discussions with oil traders, with junior lenders, of whom many of whom we're very close to in the oil and gas specialist markets, and moreover, we've got existing relationships that we've utilized for acquisitions that we can tap into for further funding. We don't expect to be doing another convertible deal in the same shape and form. We expect to be doing something similar, either with pure debt or in a similar structure with better terms going forward. And we look forward to updating you guys before the end of the third quarter on our progress.
That's great. Maybe it's a good time for me, if I may, just to jump in to thank you, Ryan and Arthur, for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just ahead of addressing today's questions, I'd like to remind you that a recording of today's presentation, along with a copy of the slides and the published Q&A, can be accessed via the Investor Meet Company dashboard. Obviously, I'm just really mindful of time, and thank you for such a comprehensive update. And I know you specifically wanted to spend a bit more time, given the number of pre-submitted questions around the topics of commonality, which I think you've addressed. There are perhaps a few questions that we could look at to use our remaining time together. And as I said, obviously we will make all the company available to all the questions, and I think there's a number of written responses already that we'll publish a bit later on. We have got over 300 people on the call still, so I'll go through the questions now, if I may, Arthur. The first question reads as follows: how long after the Ryder Scott report is published do you expect it will take to finalise and inform shareholders that the resource-backed loan has been established? And following on from that, can you outline your forward expectations for the company output of barrels of oil per day by the end of Q4 22 and then Q1 23?
Well, the first thing, Mark, is that Ryan made quite clear is that this resource report has got nothing to do with what our ability to borrow a loan or get a reserve-based lending facility. A reserve-based lending facility comes off our proved and probable reserves, and what's changed is we've bought CUDA. So, and as well is that we know, and the banks have said to us, take care of CUDA first, because having a bankrupt partner would have made it very difficult for us to get a loan because we were carrying them. So that's done. We have CUDA in hand. The resource report really goes to us about, we'll call the upside of the business, and it doesn't control our ability to borrow. As far as production forthcoming, is that we will have an updated reserve report from Ryder Scott, which is a different kind of report, and with CUDA put into it at a new price forecast. Now, we don't have that in hand. It take a little while to put together. We're in holiday time. And so hopefully things don't happen with them. We can't push them. We just say, hey, we're dealing with banks and we need this by the end of the month. And so far they're on to that schedule. Now, that's a much different schedule for them than a resource report, because their business is evaluating reserves, and they're two different things. And I try to make that clear. So as with the production forecast, they're aware of what we're doing in the field. We're talking to them on the pressure issues and things, and we know what these wells are capable of. We're just getting them stabilized and back on production and trying to forecast which of the next ones that are going to go. So their production forecast from published at the end of March still holds. It's just been shoved back, a few months, and that hasn't changed. And we know that much. What we need to do is see, where these wells are going to sit, because we can forecast them in calculations and simulations all the time, but what we have to do is see some things and open them up, and flaring gas is given that ability. So I would say, around by the end of the third quarter, we should be fairly close in understanding where we're going to be here at the end of the year. And if things continue on the way they are, is that, right now it's just like a bunch of dominoes. They all want to flip down. And so, we're seeing evidence of other wells starting off of the last three, and the fourth one, which we're about to start here to convert. There's other ones starting to act up as well. And so, I wish I could say that we can predict it, in detail. We're getting closer to that point, because, when it happens twice, you got 2 points on a graph. When it happens 4 times or 5 times, you got more points and more correlations, and you can correlate things not on a graph as well on a graph. Look at your observations, plot it out on a map, and see where it's going to go next. And that's where we are here, and we're in a much better position to do that than we were 3 months ago. So
okay. That's great. Thank you, Arthur. Let me turn to the next question, if I may. Is there a local constraint on the ability to export high volumes of oil, i.e., is there a little point to drilling 5 wells? Maybe I can just give a bit of color on that.
None. No, there's none at all. The only thing we have to do at the Barren Flats area, which there's the picture of the field or the plant in there, is that any oil that comes out of the deeper zones has to be segregated in different tanks than the produced oil from Barren's Flats. And that's an easy thing for us to do. We own all the roads, we own all the facilities, and initially what we're doing, we'll just put the oil in a tank truck and tank it out, and it goes to a terminal. It's put in a pipeline and it disappears. So there's no constraints downstream of us for selling or producing the volumes of oil that we think we're going to do.
That's great. If I turn to a question from Anthony C. Thank you, Anthony. What is the estimated percentage recovery of the 1 billion barrels?
The range goes from, until you see how things go, from anywhere from 4 to 15%. Okay, and that's or 5 to 15%. That's normal for the business. So you can take the midpoint of that and say it's 10. Now, one of the things that we're doing here, the picture on the front page here shows our facility, and it's designed for enhanced recovery. And so one of the reasons why we're starting off where we are on the east side is because we have those facilities all there, and we have a independent firm and specialist reservoir engineers in Denver, very well known, Independent Reservoir Technologies, who essentially did all the engineering work on the miscible flood and continue to simulate it for us. And we've already in discussions with them about how to place these horizontal wells in the frontier, and at the same time, instead of primary production, because right now the frontier doesn't have a drive, just the same way that the Shannon did in the other our miscible unit. And how do we go early on from primary recovery to secondary recovery as we go? And so, their initial thoughts are we drill, horizontal well pairs, eventually put a vertical injection well in between them, and start going off on that way from day one. So it's really not an easy answer to give, because we're certainly not looking at drill the whole area up and put it on primary production and then come out to some secondary recovery scheme, which is going to increase the recovery factors. It's to do it in stages, okay, is what we're planning on. And the way that the units are designed is we can do that. And so, it makes sense for us to utilize our facilities first where we have roads. We can use the associated gas that we produce off these wells to inject into the Shannon. But at the same time, we've got the facility there that we can easily expand to put enriched gas down in this area. So that's one of the reasons why we're cutting cores. We're actually collecting reservoir data so we can start with a mindset on that. But if you were in a range from 5 to 15%, you're not out of order. Okay. So take the midpoint, 8 to 10.
That's great. Thank you.
And that's the same in Western Canada and Alberta, which has got the same age sands. They behave the same way. It's not, we're not making it up. You can go other places and find it by analogy. Okay.
That's great. Let me just turn to a question from Richard very briefly, if I may. And there was a number of questions around this. But when will the rider report be made available to investors?
We've chosen for now. I say this is when I talk to people, is they think that this is a very simple report for them to read. It's not. I read it 5 times, okay, before I put the things in this press release. Ryder Scott is very hesitant to put this out publicly because there are, frankly, an awful lot of things that will be misconstrued in it. For example, the deterministic evaluation of the Frontier 2 and the Dakota is pretty straightforward because it's based upon the already proved and probable reserves that we have at Coal Creek. And so what the oil in place numbers there are for the number of acre feet of reservoir and the recovery factors are all there, and that's in our existing reserves. When we get into the prospective resources, it's a probabilistic determination. And so in there is what's called a Monte Carlo simulation on various factors and various, we'll call inputs around what they believe the oil in place numbers are, which is we'll call the baseline. The baseline is a very large number, and they're not comfortable releasing it, and that's fine. And what I'm trying to show everybody here today is that there's more to this story than meets the eye, and it's subject to interpretation, and it's their numbers. Now, we have an awful lot of shareholders who, some of them communicate with me by email. Some of the emails aren't very pleasant. They post a lot on the internet, and they are not experts. They aren't technical people. And the last thing we want is for, frankly, people that aren't technical, that aren't sophisticated, to get their hands on information that, frankly, they don't understand. And I'm not hiding anything. If what I written down is right out of that report, there is not a simple summary page in there that says, here's the summary. That's not the way it's written. It is complicated. And so what I've presented today, the maps are right out of their report. Everybody should feel comfortable that it's been mapped and that the horizontal well locations of the start are in there, and that's their name is on the map, and that's for now is going to the way that's going to be. I've given it to 5 individuals who are outside of the company and said, what would you do given and read this thing? And they all came back and said it will be totally misunderstood, and they won't understand it. We tend to find that if somebody communicates something with me, they post it up on the internet, and then things get changed, and then we've got no control over that. Now, we aren't obligated by regulation to give a resource report, and in fact most, if not all, Canadian companies do not do them. And the reason being is because they're technically complicated. It's not as simple as a reserve report is in the way to report it. So if there are those here that choose to say I'm hiding something, I'm not hiding anything at all. I've written it down. It's true and plain disclosure. But what we don't need is that unsophisticated, and I'm not saying that the wrong way, is that where I come from in Canada is that if you're a qualified engineer, if you're a qualified petroleum geologist, then if you want to make comments on these kinds of things in a public forum, that you have to have the credentials to make the comments on them. Because, people that aren't qualified don't know how to design a bridge. And so, it's easily misunderstood. And that's what we don't want to have. And so, I'm sorry, but that's just the way we're taking it. Ryan, you have anything you want to add to that?
No, I think what I'd add to that, for the various shareholders commenting on the legality of disclosing the report, the report is not required for disclosure, and it's been summarized accurately in the press release that was provided Friday. So there's a lot of comment on the chatter board on it, and that's the reason we're answering this question.
Yeah, if there are reserves, absolutely. If we update the reserve report and we have one in hand that changes the value, the net asset value of the company, that's materially changes it, then we're obligated to to release those in a form by regulation, as we've filed in the end of March, which is called a 51-101 Form F1. So
yeah,
it summarizes the reserve report. But this is like putting in a square peg in a round hole, essentially.
Yeah. I'm going to answer a question quickly on the RBL, which has come up a few times as well and was just submitted. But once we get the RBL, do you think we can buy out the oil hedge? So the answer is that, one, we can buy out the oil hedge at the point that we draw down an RBL. Two, that's something we'd consider as and when we enter into the RBL and once we review terms. The third thing I would state is that each and every bank has a different process and different requirements to lending. They'll also have very different requirements or views as to the level of production that should be hedged. One thing that shareholders can count on is that hedging will be required. But if you're going to do a deal with a commercial bank in the United States, it's very customary that a level of hedging is implemented. And that's the same thing our senior lender did in 2021 when we bought Atomic. What we will do when we go forward is we'll review our hedge book against the production profile, and we'll determine a level of hedging and either determine if we roll our current hedges into our new lending arrangements, which is something that's commonplace. And that might be of more benefit to us than trying to undertake financing to buy out the hedges, or depending on where commodity markets are at the time, to close them out. But it's something we'll evaluate over the coming quarters as we're negotiating with banks.
That's great. Well, Ryan, Arthur, I might just jump in, otherwise I could easily keep you here for the rest of today.
Yeah.
And thank you once again to all the investors for submitting questions, and we will make them up.
I'd just like to thank everybody for coming along. We're going into an exciting phase of our business. And I should like to add, because it's around this resource report, it's just a snapshot in time. You drill one hole, it's all going to change. Okay. And that's why people, where I come from, don't do it. Reserve reports you have to do. And so we drill these wells and get them producing before the end of the year. Guess what? It's all going to change. And reserves, where you got contingent resources, and reserves where you currently have prospective resources. And so everything changes, and there you go. Okay.
That's great. Arthur, Ryan, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure your feedback will be greatly welcomed by the company. On behalf of the management team of Canadian Overseas Petroleum Limited, we'd like to thank you for attending this afternoon's presentation. Thank you for your time, and may I wish you all a very pleasant afternoon.